In today's class, we'll talk about the concept of market value added. And this is another important mechanism for evaluating the performance of your management team. Let's understand the definition of MVA. MVA is the additional market value added by management. So if you start a company, and when you start the company, the book value of equity is 100 million. And 2 years later, let's say the market value of equity is 170 million. Then the market value add is 70 million. Okay, let me just give you a very simple illustration so that everybody is clear about what we mean. When you start a company, let's say that the investors started the company by putting in 100 million of their own cash. All right. So how many people can draw or create a balance sheet given this starting transaction? Okay, so you invest 100 million of your own money and you start the company. Okay, so called XYZ Inc. What does the balance sheet look like and what is the book value on day zero? How many people can actually do this? What does the balance sheet look like? Yeah, so your balance sheet simply looks like cash is 100 million, and what do we have on the right side of the balance sheet? So equity is 100 million, so that's your balance sheet. What if you had started the company, had a somewhat leveraged position, so you had also taken out, in addition to putting 100 million of your own, you had raised money through a bond issue where you raised 50 million through a bond issue. Then what would the balance sheet look like? How many people can, I want to see if without looking at each other's work, how many people can actually do this? This is the most fundamental. If anybody can't do this, I'd be concerned. So you've understood the question. You put 100 million of yours and you have borrowed 50 million through a bond issue. Your balance sheet is simply how much cash will you have if you put 100 of yours and so your cash is 150, your debt is how much? 50, and your equity is 100. So the total assets are 150 and the total debt plus equity is also 150. So quite a number of you unfortunately did not get this. Now in the two scenarios, scenario 1 and scenario 2, is there any difference in net book value? The net book value is the same. Yeah, so the net book value, your net worth at the start of the project or start of the company, day zero, is 100. So if we say equity is 100 in both cases, is that correct? Yes. So if we say net assets is 100, is that correct? Net assets. Yeah, so net assets. What does net assets mean? Yeah, so assets, so in both cases, net assets equal 100. So net book value, net assets, equity, are they all synonymous? Yeah. So the terms, in fact, there are 3 or 4 terms that you will hear which all mean the same thing. So equity is 100, net assets 100, book value of this company 100. Sometimes people want to be overly diligent and say net book value. So all those are 100 for both companies and they are effectively all synonymous. Okay, does everybody get that nice and clear? Okay, so this is the picture on day 1 or day 0 when the company starts. If 1 year later you do a market value of the company and the market value of the company is still 100 million, has the management added any value? No. So if you still have that same 100 million in cash or 150 in cash and you still owe 50 million, the management has not added any value. But if 1 year later the market value of the company has gone up to 170 million, in other words, an external buyer is willing to pay 170 million for this company, then the management has added value. How much value have they added? What's the, yeah, the market value add is 70 million. Where do you think that value add came from? Why would somebody be willing to pay 170 million? Yeah, that would be an accountant would simply say goodwill, but finance people need to recognize where, or business people need to understand where that 70 million is coming from. So where do you think it came from? Yeah, so obviously over the 1 year, they must have done something good. They must have developed a good customer base. They have developed a good product. They are selling the product. And where is that value of 170 million? How do you think it's calculated, Saad? Yeah, so based on all their good work, if they've built up a good customer base, for example, and they have a nice operation, then there is obviously a good projected future cash flow, and the present value of that future cash flow is 170 million, okay, simplistically put. And clearly a management that has been able to do this over 1 year has done a good job. Yeah, so obviously I have done a gross simplification, but as is obvious, this class needs to at least understand the basics before we get into the finer points. Okay, so that's the core point. Okay, we are just understanding do you understand the logic of this market value add now? So the logic simply is a management that creates more market value add is obviously doing a good job. Okay, simply looking at how book value changed, does that help us? Let's say that 6 months into this company, the owners put in another 50 million. All right, what would happen to the book value of the company? It would go up by 50 million. So now net equity goes from 100 to 150. Should management give themselves a big pat on the back that book value has increased by 50%? Should they get any bonus for that? Not really, because it's no credit. It's just the owners put in more money, so the company became bigger, but no value was added. Okay, so that's a key point. So now, when we talk about the concept of value-based management, what does that mean? So value-based management, I'll read the bookish definition and then make sure you get it. So value-based management is the systematic application of the corporate valuation model to all corporate decisions and strategic initiatives. The objective of value-based management is to increase market value add. So in plain English, what this means is that if you are managing or making management decisions based on a simple criteria or a simple lens, which is to what extent is the market value of my company increasing by doing this project or by making this decision, then you can simplistically say that this is value-based management. And this should sort of ring a bell in your head. The bell that should be ringing should have NPV written on it. Why? Because what is NPV? So that is how much additional value is being created. So when you evaluate projects based on NPV, whether you know it or not, you are in a sense doing value-based management, because you are accepting projects where the NPV is high or positive. Okay. So now let's go one level deeper. So you've understood what market value add is. It is the additional value created by management. So what are the components or what are the drivers of market value add? And I hope you will get a sense for this, that even if you are not a finance major, you need to understand what is it that creates value for a company. Okay, so if you don't understand what is it that makes a company more valuable, then your career will not go beyond middle management. All right, so as long as you understand what it is that makes a company more valuable, obviously that is a key for your success and your company's success. All right, so market value add is determined by 4 factors. The first is growth, sales growth. Clearly, a company or a management that can sort of that has sales that is growing at a rapid rate, do you think that adds to value? Okay, so in general the answer is yes, but is it possible, just think about this, is it possible that the company is increasing sales rapidly but destroying value? Amit? Is it possible? How? Yeah, you're on the. So if you are making, like, I sell a product that costs me 100 to make, and I start selling it at 90, which is below all competitors, do you think I can have huge explosive sales growth? I could, but is that necessarily good? No. So while sales growth is important, there are several other factors. Profitability also matters. Okay, so for me to be creating value, I should have increase in sales, and I should also have good profitability. Does that sound reasonable? Okay, so the two factors so far, one is sales growth, two is profitability. Okay, so let me. Yeah, so I don't. There might be a deeper point in what you are saying. So I'll imagine you are Shakespeare and put meaning at a deeper level into what you are saying. Okay, it is possible that you are selling 100 million today, and let's say that your total cost is 110 million. Okay, by going from 100 million, and let's say a large percentage of that 110 million is fixed cost. Okay, then in that scenario, if I go from 100 million to 200 million, then the explosive growth might improve my profitability. On the other hand, if most of my cost is variable, then doubling my sales will also double my cost. And if I was losing 10 million on 100 million sales, I'll end up losing 20 million on $200 million sales. So that would be bad. And I assume that's what you meant, right? The previous one. Okay. Yeah, so the question is, when a company tries to increase sales, and we'll see an example of this. If a company is losing money and tries to increase sales, then obviously that strategy works if most of your costs are fixed costs. Okay. Anyway, so far we are saying sales growth matters, operating profitability matters. A third one is capital requirements. And the way this is measured is by something called the CR, or the capital requirements or capital ratio, which is operating capital divided by sales. Okay, so higher the better or lower the better? So, Ayman. So capital, obviously I didn't ask the sales growth, higher the better, lower the better? Yeah, operating profitability, higher the better, lower the better? This capital requirements ratio? Yeah, lower the better, because ideally, so this is your operating capital divided by sales. Okay, so ideally you would want your denominator to be high. A good company can generate high sales on low capital. Okay, so does operating profitability take that into account? Not quite, because operating profitability, your operating profit over sales, is only concerned with income statement items. What is this ratio doing? This ratio is taking both the income statement and a balance sheet item. So it is looking at what is your operating capital divided by sales. That's an advanced topic. These are items that impact your MVA. Book value goes up and down based on accounting book transactions. Okay, so which accountants worry about. We need to know them, but we worry about what really happens. Okay, so the weighted average cost of capital, how does this matter? Yeah, lower WACC, but in a business sense, how would you explain to your CEO who came up a marketing track that the weighted average cost of capital is important in generating value? The cost incurring what to make lollipops? No, when we are talking about weighted average cost of capital, it's the lowering the cost of what? Exactly. So even a marketing, based CEO will understand that if you can raise money at a low cost, that's better. Okay, so if you can raise money at a relatively low cost, that also is a source of value. Okay, so can you stare at this for 30 seconds and memorize the 4 value drivers? Okay, so the question is why does this ratio, operating capital over sales, matter because we are going to sell our capital at the end of the project. We are actually taking a company perspective here. So imagine you are Engro. Okay, do you think when you are setting up a plant, all right, what is your mindset? Is your mindset a going concern oriented mindset, or is your mindset that, okay, I can spend $10 billion, but it doesn't really matter because after 3 years I will sell the plant for $10 billion? Or are you concerned with the expense of 10 billion relative to the profits or sales that you will be able to generate? Obviously, you are concerned about, in general, a company will be concerned about what sales are being generated relative to the money that is stuck in the capital. Okay, so that's always important. Anytime you can run a business where you can generate high sales based on low capital, that's a good thing. Okay, perpetuities, growing perpetuities.
But the cash flows are
Okay. All right, so let's focus on the core theme. We can discuss these items after class. Okay, now, I don't expect you to know the derivation of this formula, but I expect you to memorize the formula, and I will help you understand the logic behind it so you can memorize it easily. Okay, and a similar iteration of this formula is given in your books, equation 15-3 on page 521. Okay, so what is the formula for market value add at time t? So this means that if the company started at time 0, the market value add in a given year or a given period t is equal to the sales into 1 plus the growth rate divided by WACC minus G. Okay, now the way you can understand this is as follows. Okay, so clearly what you can see from the left side of this formula is higher the sales or higher the growth rate, the greater the MVA. Does that make sense? Okay, and if you notice over here, this formula should look somewhat familiar. This should remind you of your value is equal to D1 over R minus G. What is D1 being replaced by? It's being replaced by sales. Notice that actually a better way of putting this would be D naught. So value at time t would be dividends at time t into 1 plus G. So the D is being replaced by sales and the R is being replaced by WACC because we are taking a overall company perspective. The sales are flowing to all investors, not just equity investors. Okay, so the higher this expression on the left, the higher the MVA. But we also need to worry about the expression on the right. Very simplistically, if your operating profitability is low relative to your cost of capital, then is that a good thing or a bad thing? So if this is low relative to, say, a high WACC, then what happens to this overall MVA expression? It will become negative. So if MVA is negative and your marketing boss comes and tells you our stock price seems to be going down for some unknown reason, let's double sales, let's hire more salespeople. Okay, what will you suggest? That might not be a good idea. We actually need to work on making ourselves more efficient, reducing our costs, maybe reducing our cost of capital. So that's more important right now than trying to increase sales. So that would be the diplomatic way of putting it. Okay, there are other less diplomatic ways that we won't go over right now. Okay, yeah, but can you imagine how ugly this would become if I put that entire expression in here? Okay, so the point is, we assume at this stage that you understand how to come up with WACC, and the other point is that in general companies will have a WACC. Okay, your finance, your junior associate will have calculated WACC based on what you already know. Okay. So does this high level point make sense? Okay. Okay. Actually, WACC, so where is WACC coming from? WACC is coming from your cost of debt, cost of equity. So it might not be so easy to just lower your WACC, right? So probably the item that you have most control over is your profitability. So WACC will depend on external factors. How much your bank charges you, if most of your funding is coming from a bank, what is that funding? Or it also depends on the cost of equity, which depends on the equity betas and market risk premiums.
WACC is exactly not in your control.
Yeah, WACC is much is less in your control relative to operating profitability. So that's why this is what you would focus on. Another point is, obviously, what is the importance of WACC? Conceptually, if you are running a business where the capital requirement is very low, what does that mean? Okay, what in the corner, what's Adil? Raza. What does, so if in this scenario, if you have high WACC, is that a problem if your capital requirement is very low? You see, so if you have a high WACC, if you are a company that is not very capital intensive, that means that you don't need too much capital. So what will happen there? What happens? What was CR? Do you remember from the previous slide?
Capital on sales.
So it was operating capital divided by. So if this is a small number, what is that saying? Does it make sense that we are multiplying WACC by something that depends on operating capital? Because if operating capital, let's say, is high, that means you need high amount of money, high amount of capital. So high physical capital. High physical capital means you need high financial capital. Okay, and then that means that WACC is a rate. So this is a rate. Clearly, if this is a high number, then that will make this overall expression relatively high. Okay, so WACC in of itself is important, but it's more important to consider the rate times something. Okay, so at this stage, don't worry too much about the interpretation of 1 plus G. This is typically going to be just 1 plus, say, 0.7 or 0.9. So what really matters is this ratio. So the only thing that I have not given you a decent explanation for is this 1 plus G element. So just memorize that, and our schooling system helps ensure that that's a relatively easy thing to do. Okay, so in any case, so you remember this expression. And the larger key point here is, that if this expression is negative, it is negative because this ratio is relatively low, and if your WACC is relatively high and your CR is relatively high, then you have a big problem. And the way to solve that problem is maybe to make your assets more efficient. If your assets are more efficient, then what will happen? What does being more efficient from an asset perspective mean? Yeah, for a given amount of assets, you are generating more sales. Okay, so if your ratio here was operating capital over sales, if your assets become more efficient, that means for relatively low operating capital, you are increasing sales. So when you say become more efficient, it could mean two things. It could mean that for every $100 of revenue, you are generating more profit. So that's an income statement perspective. That means you are trying to increase this. Another way of becoming more efficient is for every $100 worth of assets, you are generating more sales. Are both of those good things? Yeah, so both of those good things do what to MVA? If you can increase operating profitability, that will increase MVA. If you can increase your efficiency by either decreasing WACC, which is a little hard to do, but more importantly by decreasing this ratio, that's also a efficient thing to do. Okay, So hopefully that made sense. Now the next few slides are just hammering in the point that I've just made. The way I structured the discussion was I just gave you the whole expression and showed it to you. What these slides now do is take every component and drill in. So the first bracket is the MVA of a firm that gets to keep all of its sales as profits. That does not have to make additional investments. So this is saying that if a company can just have sales without any investment, is that possible? Okay. Of minimal investment. This is just thinking aloud. So give me an example. Yeah, but that machine has the machine has cost. There will be labor, so there will be all sorts of. Yeah, anyway, it's difficult, but this is a theoretical. This is a theoretical limit where if you have no expenses whatsoever and you get to keep all your sales and the sales are growing at a growth rate of G, then what is the value generated? It's sales into 1 plus G. Okay? So if you can figure out a way of creating lectures and selling them on the internet, okay, so that is a good business model where what you can do is generate sales with minimal cost. I'm actually making a more subtle but a very important point here. When if you go start your own business, think of creating a business where your capital requirement is as low as possible. Okay, if you can generate decent sales with low capital requirement, that is going to really help your MVA. Okay, you don't necessarily think of it in terms of MVA, but how much value you create is always important. Anyway, so do you understand this point? This is the value generated based on pure sales and no expenses. Okay, the second bracket is the operating profit as a percentage. Is the operating profit the firm gets to keep less the return that investors require for having tied up their capital in the firm. So what's this expression? This is the operating profit. So your operating profit might be 20%. Okay, minus, you can think of this part as the return that investors require for having tied up their capital in the firm. Okay, so WACC is what? It's the return that investors require. Do you understand this expression? So WACC is what the investors require, and by multiplying WACC by a ratio, we are effectively coming up with a percentage number. Okay, so WACC will improve if WACC is so MBA will improve if WACC is reduced. Does this make sense, Rohan? Why? WACC. One second. So say the same thing. If WACC goes down, what happens to OP? Yeah. So in general, the simple way of looking at it is obviously if your cost of raising capital is down, your profits, your overall value is more. If operating profitability increases, then can we say without a doubt that MVA is going up? If the capital requirement decreases, can we say without a doubt that MVA is increasing? If sales or the growth rate goes up, can we say without a doubt that MVA goes up? Not necessarily. Okay, it depends on the other items. Okay. So the second term can either be positive or negative that we've talked about. If the second term is negative, then growth decreases MVA. In other words, profits are not enough to offset the return on capital required by investors. Okay. Okay, now I'm going to give you another expression and then we'll do an example. So the other way of looking at things, actually let me just see how many of you, based on what we've just learned, how many of you can write down the expression that we just did? And I just want you to put a break between that and this. So without just trying from your memory, try to put down the. Okay, so everybody got it? Okay. So now, okay. So let's get back to this. Okay, so the question is there a correlation between WACC and CR? So Shahama, what do you think? Is there a correlation between WACC and CR? First of all, what is CR? Yeah, so which is how much? It's what divided by what? Okay, so now operating capital over sales. So the question is there a correlation between this and, okay, nothing. What is WACC? And it represents it represents the cost of raising capital. What's your operating capital? That's all the assets, your operating assets that you have, and sales is sales. Yeah, but what is these two? Look, just take a step back. Just look at it in a simple way. So, ladies. So CR is equal to operating capital over sales. So this expression, if I say that this number is equal to, so let's say that this is 0.5. What does 0.5 mean? It means that for $1 worth of sales, I need 0.5 operating capital. Okay, so, or in other words, for $1 worth of capital, I can generate $2 worth of sales. So this number is a measure of how efficiently I'm using my assets. The more efficiently I use my assets, the smaller this number. This WACC is a measure of how much it costs me to raise capital. So there are two different concepts, but the way they come together is, in an ideal world, it is low. In an ideal world, it will not cost me much to raise money. And then if with that money I can buy assets which I can use very efficiently, then I have a great business. Okay, so if you want to think, that's not strictly speaking in the statistical sense a correlation, but there is a relationship that we just talked about. Okay, now we are talking about a different but related item which has a fancy term, but don't get scared by this term. Let's just understand what it means. How many people have heard of this expected return on invested capital? So what do you think this means, Anusha? Expected return on invested capital. So how do you think you'll figure it out? So you've been assigned, you have been hired as a financial consultant at, yeah, but explain this to us. So your marketing person is baffled by all these fancy sounding expressions and terms and so on. So can you explain this to a marketing person? What is the expected return on invested capital? Okay, all right. Okay, so the whole idea is this. So you are coming at the company at this point. So to tell your marketing people what's the expected return on invested capital, you look at the invested capital at time 0 or time 1. So you look at your capital at time, how much capital do you have at time 0? You look at, if you are sitting here, you are sitting here at time 0, you are looking at your NOPAT over the upcoming year. Okay, how is the NOPAT over the upcoming year written? It's written as NOPAT T plus 1. If T is 0, then it's NOPAT 1. So what does NOPAT 1 mean? Yeah, the net operating profit after tax in the first year, which for us is the upcoming year. So do you see why this is called expected return? Because the NOPAT is an expected NOPAT. Okay, so is high good or low good for this expression? High is good, because you would ideally want to have a high NOPAT relative to a low capital number. Okay. Another expression, and let's make sense of this. So this is the last concept for this lecture, so make sure you get it. So Rohan, can you explain this? So I want everybody else to also try and stare at this expression and make sense of it, and I'll pick people to try and explain. What do we mean by capital? Somebody who Manal? Sabah. What does capital mean? Yeah, so what does it mean? Yeah, so in this particular case, it is all the money that is tied up in your assets. So your total operating capital, the money tied up in plant, equipment, inventory, etc. So that's your capital. Okay. So Saira, do you want to explain, or somebody who hasn't spoken yet? So name? No, in front of you, Hussein. So can you explain this? What do you think? Relative to?
Relative to the returns.
Exactly. So that's the key point. So the most important part of this is what Noma picked on. So you will have high market value add if your returns are greater than WACC. Does that make sense? So obviously this expression high is good. Now if your returns are greater than WACC, then does it make sense to have a lot of capital? So if you have high returns relative to your cost, then you would be comfortable multiplying that by the amount of capital you have. On the other hand, is it possible that WACC is lower than expected return? Yeah, so if you are Pakistan Steel, then chances are that your WACC is higher than your expected return. So for an entity like Pakistan Steel where capital is very high, so what's the worst case scenario? Having high capital and then say a low expected return relative to WACC. So if this is very high positive and this is negative, that's bad news. Okay. And then the way you can think of this is if your overall capital is increasing at a rate G, then you can look at this as a growing perpetuity. And your difference here, if it is divided by WACC minus G, what's G? It's the growth rate of capital. So if your capital or your company is growing at 5%, your WACC is 10%, then what's your denominator? It's the 10% minus 5%. Okay, so we will take this and continue with the same expression next time. Today is Thursday. So a week from today we'll have a quiz and spreadsheet.